name is Muhammad Nifafki bin Rosli, 156423. Seng Industries Berhad was incorporated on 4 October 1991 and was later listed on the main board of Bursa Malaysia Securities Berhad on 2 November 2000. This company has three subsidiaries company, namely Seng Perusahaan Makanan Sdn Berhad, Seng San Hun Yun Brothers Sdn Berhad, and Incomex Food Industry Sdn Berhad. This company is an investment holding company in which its subsidiary companies engage in the manufacture and sale of cracker or biscuits and confectionery food items. Back in 1958, Seng, which translates to success with teamwork in Chinese, was established as Seng Co., a partnership by the four founding directors of the group, who are brothers. Today, Seng is one of the leading crackers or biscuits manufacturer in Malaysia. This company adopted a dividend policy distributing an annual dividend payout of at least 60% of the net profit after tax with effect from financial year ended 31 December 2009. Water Industry Berhad is one of the premier and longest established biscuit manufacturer in Malaysia. Established in 1962 and listed on the Stock Exchange Malaysia in 1992. Since then, this fast expanding company has grown to be one of the largest players in the biscuits industry in the rich country and produce a wide range of superior quality biscuits. Huatai has successfully established a strong presence in Malaysia and has built out a wide international market. Today, their products can be found locally from small sundry shops to big hypermarkets, fast food chains, airlines, and other mass consumption industries. A total of 40% of this company's production is exported internationally to countries such as China, Taiwan, Hong Kong, Singapore, Brunei, USA, Mauritius, Middle East, Papua New Guinea, Maldives, Nigeria, and 28 other countries. And they are still growing. Support facilities are constantly being upgraded with their continuous goal of producing the finished products ranges possible.
Hi, Assalamualaikum. A very good day, everyone. My name is Shamila binti Shafi'i with metric number 156232. So we go through to my part. I'm going to discuss about the current ratio of company Seng Industry Berhad and Huatai Industries Berhad from 2018 until 2022. So let's get it short. To find a current ratio, we need to apply a formula, which is a current asset divided by the current liabilities. From the chart bar shown that for 2018 bar chart show that Seng Industries Berhad has a higher current ratio compared to Huatai Industries Berhad with ratio 2.17 and 1.34 respectively. So for the next year, which is 2019, the bar chart also shown the constant concept, which is for Seng company is 2.19, while for Huatai company is 1.29. And also shown that for 2020, the Seng company should increase a bit more than 2019. This increase around 1.49 and it will be 3.65. Meanwhile, for Huatai company shown that a decreased current ratio to 1.07 compared to last year. This might because of the increases current liabilities. So we move to 2021. The current ratio for Seng is 28.94. This is increased dramatically. Meanwhile, for Huatai company is 0.95. This is because of the current liabilities. Any decreases in liabilities is a use of funding and so represent a cash outflow. So decreases in a comparable imply that a company has paid back what is owns to suppliers. Lastly, for 2020, remain the same, shown that Seng company has the higher current ratio compared to Huatai company with ratio 21.44 to 0.89. Move to acid test quick ratio. How to find acid test quick ratio? We also need to apply a formula, which is current asset minus inventories and divide by the current liabilities. So for 2018, bar chart shown that Huatai company has a higher ratio compared to Seng with 0.73 to 1.10. This might due to the inventories. Next, for 2019, the acid test ratio for Seng is 0.78. egg, which is increased 0.05 from 2018. Meanwhile, for Huatai company also decreased to 1.05. 2022, the data for Seng increased dramatically to 8.90. This might due to the current liabilities. Any decreases in liabilities, this is a use of funding and so represent a cash outflow. So decreases in account payable imply that company has paid back what it owes to suppliers. For Huatai company, data shows that the decreases ratio to 0.73. And lastly, the acid test for both companies shows the decreased value which is 0.44 for Seng company and 0.66 for Huatai company. That's all from me. Thank you.
Inventory turnover ratio is financial ratio that measure the efficiency of company inventory management. The formula is cost of goods sold divided by inventory. A higher ratio tend to point a strong sale and a lower one is weak sale. We can see under this ratio, Seng Industri Berhad turnover rate are better compared to Huatai Industri Berhad due to the higher is better. In 2019, Seng Industri Berhad has the highest inventory turnover, which is 8.1 times.
In account receivable turnover, Seng Industri Berhad show higher value than Huatai, so Seng is better company than Huatai. Significant increase in 2020 shows that Seng's account receivable were turning over 10.22 times in that year, but the rollover of the time receivable is dropped from 2020 until 2022. For asset turnover ratio, Seng Industri Berhad has better asset turnover ratio than Huatai Industri Berhad. Seng Industri Berhad better in generating revenues using its assets. Can be seen that from 2018 until 2022, the asset turnover ratio of Seng Industries Berhad constantly increasing.
Assalamualaikum Doctor. My name is Nur Shazanani Afrina and I will be presenting about the debt to total assets ratio. The debt to total assets ratio shows how much of a business is owned by creditors compared with how much of the company's assets are owned by shareholders. Debt to assets ratio can be calculated by dividing the total debt with the total assets. Based on the graph attached, Seng Industries Berhad has more assets than debt since the ratio of the company is closest to zero compared to Huatai Industries Berhad. A company with a high total debt to total assets ratio has a relatively high degree of leverage and thus might not be as financially flexible as one whose assets outweigh its debts.
Hi, my name is Nur Adila Norbit, metric number 156877. So I'm going to continue about debt to equity ratio. The optimal debt to equity ratio varies by industry, but it should not be above a level of 2.0. The formula to calculate the debt to equity ratio is by divided total liabilities with total shareholders' equity. From the graph, it's shown Seng Industries Berhad better in debt to equity ratio from 2018 to 2022. The ratio shown is below 2.0. Compared to Huatai Industries Berhad, the ratio is in between 1 to 2.5. It is a little bit higher than 2.0, but it's still considered good. But if higher than that, it's considered unfavorable. A higher debt to equity ratio suggests more risk, while a low one may indicate that a business is not taking advantage of debt financing to expand. The more debt you have, the higher the ratio will be. Times interest earned indicates that the ability of company to pay its debts. A better times interest earned means company has enough cash after paying its debts. It is to continue to invest in the business. The formula to calculate is net operating income divided by interest expense of the company. From the graph, it shows that Seng Industries Berhad better in times interest earned. For Seng Industries Berhad, the ratio shown between 1 to 2.45. It's higher than Huatai Industries Berhad, which is below 0.5. From an investor or creditor's perspective, an organization that has a times interest earned ratio greater than 2.5 considered an acceptable risk. So Seng Industries Berhad has less of a risk to investors and creditors in terms of solvency compared to Huatai Industries Berhad?
Net profit margin can be calculated by dividing net profit with the net sales or revenue, but in this analysis, revenue is used, and as we know, the more higher the net profit margin, the better profitable the company. And from the graph that we obtained, we can see that Seng Industries Berhad is more efficient at converting sales into actual profit compared to Huatai Industry Berhad in year 2020 to 2022, while Huatai Industry Berhad did not experience a significant increase from 2020 to 2022.
Return on asset refers to a financial ratio that indicates how profitable a company is in relation to its total asset. From the data, Seng Industry Berhad has higher return on asset compared to Huatai Industry Berhad, which is higher is better. The higher value recorded by Seng is 0.18% in 2022. A higher return on asset means more asset efficiency, so Seng company is more efficient and productive at managing its balance sheet to generate profit.
Return on equity, the formula is net income divided by average shareholder equity times 100. A higher return on equity indicates that the company is making a greater profit for its capital investment by shareholder. In 2018 to 2020, Seng Enterprise Berhad has increased, but it has decreased from 2021 to 2022. But for Huatai Industry Berhad, it showed that ROE increased in 2022. As we can see, the higher average for ROE is Huatai Industry Berhad for 30.2 times compared to Seng Industry Berhad is 28.9 times.
So now we will discuss about the earning per share or EPS for both company. The formula for EPS is net income divided by total outstanding share. EPS indicates how much money the company makes for each share of its stock and is widely used metric for estimating corporate value. And Huatai Industry Berhad tend to be more stable than Seng Industries Berhad for earning per share because in increasing amount of earning even though the value is not as big as Seng. And as we can see from the graph, Seng Industries suffered a loss in receiving earning per share from 2018 to 2022, while Huatai is gaining profits start from 2020 to 2022.
Price earnings ratio or PE ratio had a formula to calculate, which is PE ratio equals to market value per share over earnings per share. Based on calculation and graph, PE ratio of Seng company is more stable in 5 years compared to Huatai. In 2018 to 2020, Huatai PE ratio increased constantly, but in 2021, PE ratio of Huatai increased significantly, then dropped drastically in 2022. Seng is more big company compared to Huatai, but in 2021, PE ratio of Seng had a little bit increase, while PE ratio of Huatai rose more than Seng.
Now, let's move on to the question, which company appears to be stronger and why? Seng Industry Berhad appears to be stronger company compared to Huatai Industry Berhad. We can look at the ratio analysis. First, liquidity. Current ratio is one of liquidness ratios that measures a company's ability to pay in short-term liabilities. Seng has better liquidness than Huatai. Huatai current ratio by the year are lower than Seng's, so Seng are more able to meet companies' short-term obligation. Second is profitability. Seng shows a better and higher trend on net profit margin and return on asset compared to Huatai. Next, in context of leverage, Seng Industry Berhad has a better and efficient financing decision and propensity to use debit in financing asset. Seng has a lower debt to entire asset ratio compared to Huatai, which indicates that Hap Seng is much more stable and the fiscal base is stronger. The last one is activity. Hap Seng have higher in inventory turnover ratio and asset turnover ratio, which is higher is better due to Hap Seng Industri Berhad have turnover rate are better and good at generating revenue using its asset.
Okay, now I will compare both company and make a consideration in making investment decision. From the first aspect, which is net profit margin, we can see that Hap Seng Industry have a greater net profit margin compared to Huan Tai Industry. For example, in 2022, Hap Seng Industry have 1.6 while in net profit margin, while Huan Tai Industry has 0.069 and 0.092 of net profit margin. This can show that Hap Seng Industry has a better and higher in converting the sale into the profit compared to the Huan Tai Industry. Okay, for the next aspect, which is return on equity. For the Hap Seng Industry, the range of the return in equity is from 18 to 29%, while Huan Tai Industry is from 3 to 30%. Even though Huan Tai Industry has a greater return on equity compared to the Hap Seng Industry, but Hap Seng Industry has more consistency in maintaining the return on equity in a closer range compared to Huan Tai Industry. This can make a greater profit from its capital investment by the shareholder. Okay, for the third aspect, debt to equity ratio. Hap Seng Industry have a very smaller ratio compared to Huan Tai Industry. For example, in 2022, Hap Seng Industry only got 0.014, while Huan Tai Industry got 2.496 of the debt to equity ratio. This can show that Hap Seng Industry had a better time for recovering its liabilities compared to the Huan Tai Industry. Okay, from these three aspects, our group will be considered to invest to the Hap Seng Industry. For us to recommend a company, we will consider some of aspects such as return on equity, debt to equity ratio, price to earning ratio, and current ratio. For the return on equity ratio, the higher the return on equity ratio will give more profit relative to the equity, and while lower debt to equity ratio will be more favorable financial position and less risky debt obligation. Next is a price to earning ratio. The higher the price to earning ratio will give a higher expectation for the future earning potential. And the last one, current ratio. The higher the current ratio, the stronger the liquidity position and the better ability to handle a short-term obligation. From this aspect, the Hap Seng Industry have fulfilled all these conditions. That's why we will recommend the Hap Seng Industry.
Now, I'm going to briefly discuss about the future outlook of the company in relation to the present development in year 2023. Based on the company that has been selected, which is Hap Seng Industries Berhad, shows its ability to remain strong in the future. This is proven since Hap Seng Industries Berhad shows the potential to be financially stable in the future based on reports for several years in terms of its liquidity. Liquidity is the amount of a cash and easily convertible to cash assets a company owns to manage its short-term debt obligations. Before a company can prosper in the long term, it must first be able to survive in the short term. Hap Seng Industries Berhad had better liquidness in the past 5 years. Profitability is to survive in the long run, a company must eventually attain and maintain profitability. A higher net margin, especially when compared to competitors in the same industry, indicates a company is in a stronger financial position to invest in growth and expansion. Seng Industries Berhad has a higher trend net profit margin and return on assets. Lastly, in terms of leverage, leverage is amount of debt in a company's debt to equity ratio. A company is said to be highly leveraged if it has more debt than is typically for its sector. Although leverage is not always harmful, it is preferable to have less of it.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Amirul Hakim bin Ahmad Roziman. So I will continue on conclusion to conclude everything based on Huatai industry and also Seng industry. So in conclusion, we can see that Seng industry Berhad is doing better in its sales and operation compared to Huatai industry Berhad. Generally, Huatai Industry Berhad should think about how to improve their liquidity, leverage activity, and also profitability so that they can improve their management skills to generate higher sales. They can also improve profitability by increasing revenue, such as selling more goods or services or increasing the prices. Huatai can also improve their liquidity by controlling overhead expenses and selling unnecessary assets by eliminating items such as surplus business equipment that can provide small sum of capital. Other than that, they can distribute cash to shareholders, which is an excellent strategy to strengthen the firm and to improve their leverage. As for Seng, they can still improve even more in liquidity, leverage activity, and also profitability to preserve good performance and sustain in the future. So after comparing both of the company in previous part, we could say that Seng Industry Berhad is doing much better in most of the aspect compared to Huatai Industry Berhad. So that's all from us. Thank you.